Morning, everyone. Happy New Year to you. I hope you have a great 2020. I'm sure it's going to be a really good one. So today is the first interview that we're going to do this year, and I thought we'd come back to Des Myers. We had a very good chat last time we spoke with Des, and a couple of comments that he wanted to make around what's going on in the markets at the moment. So yeah, I thought we would carry on with just to bring everyone up to speed with what happened last year and what Des thinks is potentially going to happen this year, and his comments around that. So I guess, Des, I mean, last year we saw a continuation of the US Fed and central banks around the world continuing to effectively print money, keep interest rates very low, and a lot of that money sort of found its way into the stock market. And then towards the end of last year, 2021, the Fed started speaking about withdrawing that stimulus, tapering as they call it, reducing their bond buying, and the prospect of even raising interest rates, mostly because they're concerned about inflation. We've seen the oil price go up significantly last year, and commodity prices as well. So yeah, Des, I don't know if you'd like to welcome, first of all, welcome.
Yeah, it's certainly a most interesting juncture right now, because I think what we're seeing is markets starting the new year, as they often do. The early weeks of the new year, the market seems to continue its strong trend, if it's been in existence, the prior months prior to Christmas, which has been the trend this last year. Strong stock markets throughout the fourth quarter. And we've had another strong start to the year again. First couple of weeks, very hot indeed.
Often happens.
Often happens. It's seen people come back from holiday, they look at the new year and basically take a view that things are going to be good. And I think where the problem is, they start to extrapolate the most recent trends and think we're dealing with a continuation of what was taking place prior and carrying that through into the new year. And I think that's where a lot of problems are going to start to surface. Okay. I think there are a lot of crowded trades. I think what we're seeing is the stock market generally has been very kind to people, and for good reason. As you mentioned correctly, there's been huge central bank stimulation, low interest rates, printing of money. So it's been an easy trade. And what worries me is, with this very cheap money, I think the stock market has attracted people without great fundamental knowledge, and basically just running on the back of what has been a very profitable trend. Now, we look at these markets and we find now that the PE ratios are extraordinarily high, dividend yields are very, very thin, and these are always associated with bull markets, mature phases of bull markets, and I don't think this is any different. Yes, the markets have run very hard indeed, and probably have run further than I certainly expected going back to this time last year. But as I mentioned, I think the market is full of crowded trades, and I think with the central bank policies, as you spoke about a little bit earlier, being implemented, I think that we're looking at a very, very mature bull market overall.
Yeah, I think I would probably agree with that. Certainly the stimulus from the Fed since the virus started has been a big driver of the performance of the stock market, particularly in the tech sector. I see a lot of overseas, those tech stocks have really shot up to ridiculously high valuations. But on the other hand, I think the Fed's actions seem to have worked. The economy in the US seems to be pumping and doing quite well. They seem to have gotten unemployment under control. So yeah, it'd be interesting to see where things go next.
Yeah, I think it'll be very interesting indeed. And now certainly a critique of the central bank policies. I think that ultimately there's going to be a major price to be paid for these very lax monetary policies. I think they effectively have kicked the can down the road. They've underestimated the rising inflation, and may not be all the inflation is transitory as they would hope it to be. And you look at oil is now going to a recent high again, and that's certainly going to have inflationary consequences.
Yeah, absolutely. And I think that's why they have actually said that they're going to be A, withdrawing the stimulus, and B, starting to raise interest rates. I think the market is pricing in about 4 interest rate hikes out of the US in 2022. And, at the moment they're thinking that it might happen potentially sooner than later, because I think they are quite spooked by particularly the oil price. But I guess the other side of that coin is the supply chain constraints that, that have resulted from the virus, the new Omicron variant, and, places around the world limiting movement, etc. So that's creating supply chain shortages, logistics issues, which has pushed the prices of many of these things up. And I wonder if maybe when the virus, it seems like this new variant is not as deadly as the Delta variant and the other variants, that maybe the logistics side of things might start opening up again, and that would potentially lower the price of things like oil, etc.
Yeah, I think that will certainly come into play. That inflationary scare is very intense at the moment. And I wonder if the US economy, if we look beyond where it is at the moment, it's been very good this last year, 18 months, very good indeed. And we're starting the year on a pretty good note. And I'm just wondering if that can be maintained. May well be that 3, 4, 5, 6 months down the road, the US economy, as a result of these measures that the Federal Reserve is taking, doesn't have a setback. And I wonder if we don't see some weakening of the US economy in the middle of the year or later this year, and that results in the central banks backtracking on their policy, and maybe we don't get the large increase in interest rates that they are expecting, and in fact may resort to printing money again. So we could look at a situation which in 6 months' time is quite different from where we are today.
Yeah.
And that brings me back to the gold price. Now, the gold price has been very disappointing in relation to what has happened on the inflationary front, in relation to real interest rates, which have come down very sharply, and in relation to the inflation that we've been talking about. And I've heard people saying that Bitcoin has eaten gold's lunch. Well, in fact, I checked up on that, and I found not a very good correlation between a rising Bitcoin price and a falling gold price. In fact, they seem to be moving independently. But what I think is most interesting is that the falling gold price, or the setback that we've seen in the gold price since August 2020, from 2070 back now to 1800, I think the main factor that's basically taken away the lure of the gold price has been the rising stock markets, and particularly the American stock market. I had a good look at what has happened to the gold price. Let's go back to a period just immediately after the virus struck. That's going back to March 2020. The S&P was at a low of 2,200, has risen now to, we know, around 4,700. I think it's a rise of about 120 odd percent. And that's a dramatic move, and the gold price has certainly underperformed that in a major way. And if we look at a more...
I think you said 25%.
25%. So, I think what really is happening is money has moved into equities. World stock markets have attracted a lion's share of funds, besides Bitcoin and a few other areas, and that money has, the money that would have gone to gold to some extent, has been attracted to rising equity prices. And I've done a graph of looking at the gold price in relation to the S&P index, and what is most